Hi, friends. Welcome everyone to our show. Today is a new episode, Season 1, Episode 20. If you have been here before, thank you for coming back. If you are new, thank you for coming back as well to check the channel and to see if there's a good match for you. So, today's episode, you're going to find out a lot more information. And before any further ado, let me introduce the channel. It's your host, Rahim. Channel name is Fine Print Canada. And here we discuss specific points targeting Henrys, specifically in Canada. So, if you are eager to find out, or if you are curious after this short intro, stick around and let's get right into it. But before we do, as always, like, share, comment on what you like, what you don't like, what you want us to improve, and let's get right into today's episode, Season 1, Episode 20. Two investors, same ETF, same amount, same return. Now, before you skip the video or try to find something more interesting, I want you to give me just 5 minutes of your time. That's all I'm asking for. That's it. 5 minutes of your time to see whether it's worth your time to spend on this video. So let's begin straight up. One pays hundreds of dollars a year in tax, the other one doesn't. You might be wondering how is that possible? If there are same investors, if they are same Canadian, if they have the same ETFs, same amount, why is one end up paying taxes or income on that generated asset, but the other one is not paying anything? How is that possible? If that's get you wondering, you're on the right track. And remember, difference has nothing to do with what they bought, right? We are assuming same salary, same investors, same income, same Canadian household. Everything is exactly the same. Imagine A, B. Same path they are going, but one chose a different shortcut, the other one decided a different route. That resulted in this output. If that has made you curious, let's find out how exactly they managed to do it. Here you go. 43 cents of interest income gone before you even touch it. I'm wondering, what the hell is that? The next one, 15% is withheld by the IRS on US dividend stock. Now, that might be wondering why I'm talking about IRS, right? They are in US, we are in Canada. This is about to show off Canadian Henrys. We deal with CRA. Why is this guy talking about IRS? Doesn't make sense. Hold on. I told you give me 5 minutes. I'm going to explain everything step by step, slowly, and in a particular fashion to make it easily understandable. Okay. $0 withheld inside the RSP. Treaty exemption. If you don't know what the exemption is, in short, RSP, if you hold investment in that particular section, there's a treaty between US and Canada that you won't get taxes or taxes particularly withheld from you. That's the basic gist of that thing. All right. Let me show you how. So there is basic three income types and three completely different tax treatment. You might have heard about it, you might already know about it, which is great because let's be honest, most Canadians have no idea that they exist. So if you do, pat on your back, you at least have some idea and you're basically a bit ahead of other Canadians who are watching the video. But just a quick recap as always, right? So, as I was talking about, three income types, three completely different tax treatment. You must be aware of it, you might have thought about it, or you might have no idea about it. If any of these criteria or categories, let me show you exactly what they are and how they affect regular Canadian Henrys or regular Canadian. The first one, as you see on the screen, interest income. This means income generated from a GIC, bond, ETF, or a HISA account. HISA is high interest saving account, if you are not sure. How are they taxed on non-reg account? That means non-registered account, 100% taxable, right? So that means let's assume you have $100, it pays you 5% interest. So you made 105 dollars, right? Simple calculation. You get taxed on the entire $5. There is no break for you, tax break for you. So effective cost is 43 cents per $1. So the best account to put this kind of investment income, specifically interest income, is either RSP, Registered Retired Saving Plan, or TFSA, Tax Free Saving Account. Next, Canadian dividends. So they are either from Canadian shares, cash, ETFs, or specific ETFs that focuses on Canadian companies. In this, you at least have some breaks, which is called tax credit that applies. So it's partially sheltered and is better compared to the first option of interest income. As you can see, 30 cents effective compared to the previous one. The best account to put this one is a non-reg account. Yes, I'm sure you might have not heard it or you might have not been told about this, but that's the way to do it. Canadian dividends, non-reg account. This means regular account that you pay taxes on. If you're wondering why do we do this, hold on. We'll explain it step by step. There's no rush, right? Third, capital gains. This comes in when you have equity ETFs, stocks, when you actually sell it. How are taxes on it? 50% inclusion, right? That means you only pay tax on 50%. Same example, if you had to invest $100, you made 150, you're going to pay taxes on just 50%. As you can see, 21 cents per $1. This is best to put in non-rich account. Again, right? You see the similarity and differences between non-reg and reg? I'm sure most of you are watching this episode usually have their ETFs or have their stocks and know about the account, but you're not sure how the tax treatment works, or you have not paid attention to it because it's so much information, right? So much bricks coming to you. You might be thinking, oh, it's all the same, right? Just put it. Or you just ask someone that you trust or AI, what is the best account to put in? They gave you some idea, you didn't do any much research, right? And you just went through it like crazy. Like, okay, this is what I'm going to do. Yeah, that's it. But now look at these three income types. This gives you straight up view to what each of them has and what most of the income generated in Canada, or specifically income generated in Canadian or for Canadian, comes under three types of income. And those are interest income, Canadian dividends, and capital gains. And one more for the bonus part, we will stay around foreign dividends. These are your US stocks, two ETFs which are very famous in Canada, XEQT, VFV. How do they work in non-reg account? 100% plus withholding. This withholding means, and we're going to discuss more about this, but for now, understand IRS takes 15% first. Just understand this for now. We're going to explain what is it in depth to understand what IRS has to do with us. So, if you have this, effective cost will be 43 cents plus 15% to IRS. Now, the best account to put these kind of dividends is in RSP, right? Remember, not TFSA. Although is a reg account, the best place to put these ones is in RSP. And you'll understand when we proceed further in this why are we more favoring RSP compared to TFSA. All right, let's see. So now I have taken two common example of the most famous, well-known, publicized, and high ETFs that most of Canadian investors should, will, and have come across sometime in their life if they are serious about building wealth. These two are our XEQT, VFV, correct? XEQT is owned by BlackRock, VFV, Vanguard, right? Now, why I'm showing you these two specifically? Because this is easier to relate when I show you some diagrams or some visuals. Sorry, some visuals, right? Rather than trying to understand or make you show a lot of images, a lot of data, right? You will get bored by it. This is more interactive for me. And you see all these pie charts, right? You've seen a pie chart. You know what this means, right? So let me hover over everything what this means. So you look at this big red one, that's US equities, 44%. This means if you own this XEQT, if you bought this, it holds 44% of US equities. Next, the green is Canadian equities, right? It owns 26% of that. International equities, 24.7%. Emerging markets, 5.3%. Now I know most of us have heard this that XEQT is called a global ETF, right? Because you think it has emerging markets and it also has international equities, right? That is what is sold by. But now I want to look at this particular diagram. Just look at the diagram. You have 44% US equities and 26% of Canadian equities. That means it's clearly more than 60 to 70% in US and Canada. Highly concentrated. So even though they might sell you as international equities, if you invest in this, you're basically investing in Canada and US only. You're not diversifying at all. Just a side note I want to let you know because it's mostly sold as world equity. That you get this, you're done. Just one equity, one ETF, simple, quick. But remember, if you choose this, you're consciously making a choice to make an investment in Canada and US only. That's it. You're not going anywhere else because assume the portfolio or the market that will drop if you're not aware of this because it's way too high. Your this portfolio, if you only have this, is going to go down dramatically because remember, 40% is owned by US, right? And whatever happens in US happens all across the world, but specifically in Canada as well, right? So this portfolio under bad times is going to go way too down and you might be stressed out and sell it. So just be aware of this. The MER of this is 0.2%, very low, right? That's the whole idea of owning an ETF compared to mutual funds. MER. We have another one, VFV. This is, as you might have guessed, straight up US equities, 100%. There is no diversification in brackets, right? There's no other equities. They just tell you, hey, Vanguard is tracking the S&P 500, deal with it. That's all we are here, right? Now this is where the non-rich account comes in. IRS withhold 15% of the US dividends before they reach you. Partial recover only on T1. This means if you hold this in non-rich account where you have taxes on it, they're going to withhold 15% of dividends that comes from these categories, specifically from XEQT and VFV. This means, again, example, you own $100 of this, so you might get two or three depending on what the price is. Specifically, this is going to be way higher than this one, but let's assume you bought your $100, you paid for your brokerage, you got 2 units of it, right? Now they are going to pay dividends either monthly, quarterly, or semi-annually, depends on their how they are structured, right? They pay you, for example, $10. It is hypothetical scenario, right? Each of them. If they pay you $10, 15% of that is already withheld. So you won't even see that money. If you hold in non-reg account, very important. If you hold this in non-registered account. Now, if you hold the same ETFs, exact same money, exact same unit in RRSP, the Canada USDT we talked about, that is zero withholding. That means they won't withhold any dividend taxes. So that means you get all that $5 or $10 we talked about straight, you can see it into your account. Now obviously you can't take it out because it's RSP, right? It's for retirement. But you have that over there. But if you have it in a non-reg account, yes, you can sell it, obviously, and pay taxes on it, but you will not get the entire of it. You will get only 15% less than what you're supposed to get holding the same unit. Now you might be thinking, okay, 15% is not too much, right? This is two ETFs, 2 units of ETFs, right? You're probably going to assume or going to get more than this, probably hundreds, 200s, 500,000, right? Depending on how you structure it. Now imagine all that 15% losing in that. You lost that much money first in taxes because you pay tax on it when they pay dividends, right? We talked about it. And then you don't even get the entire 100% of it. While the same person holding the same ETFs in RSP gets the full tax benefit. They just can't sell it, but they still have that money and it's growing. And they pay zero taxes on it as long as inside the account, right? So this becomes very important when you have it a long-term view of 10, 15, 20 years for retirement. If this is going to be a retirement portfolio, just these two if you want to keep it simple, right? I recommend not this one based on my experience and what I have done in my investment because it's obviously right way too into consideration of US and Canada. And we know stock market is already at the way high and it's going to be a drop down. If you're not sure, sorry to wake you up, but that's going to happen. So if you have these two portfolios, remember and be mentally prepared to have a big drawdown, 70-80% easily if you hold these two. So I recommend just not holding these two or remembering if you hold this, ready for the mental breakdown or torture. Let me reveal you all the percentages so you can have a look at properly. Here are your percentages. You can see clearly now. US equities, Canadian equities, international equities, emerging market. And this one is straight up US equities, right? Let me show you the withholding problem if you're still here with us. Executing a non-reg account. So what actually happens with dividends, right? It's a proper example. So let's say you have 100K invested over here. For US equities, you're going to get 44K from that. Dividends, 1,100. Withholding, $165. So you received only $99. You see, that's on a small level. I imagine you're going to have a lot more money than this. So you're losing it every single time. So non-registration leak or account leak will be $66 for every 100K. Now you might be thinking again, $66 on 100K, what is it, right? It's not worth even my time. But remember, you're losing that money just putting in the wrong account. You can use that money if you compound it over a long time. Same investment, nothing has to be done extra, right? You put that in RSP, $0 leaking. Now imagine compounding that for 10, 15, 20 years. That is a big difference. You might not be able to see it. It might look very similar or very small, but the end result, you will be shocked. And if you have any doubt or you think these are just I'm making it all up or something like that, go do your own research, look for the fun facts, look put a actual scenario that you can put in that how much I'm going to lose in this one, how much I'm going to put in this one, then you will be shocked by the numbers that you see. Yeah, you can test it out. You don't have to believe me, right? You test it out and see how it goes. And this is a very important topic. The investment community spent decades depending what to buy. Almost nobody talks about where to put it, right? Be honest. Before this video, do you ever thought of where you're going to put your ETFs or stocks or anything? You just thought, okay, I got my RSP, I got my TFSA. What is the common advice for all of us? First, fill up your TFSA, regardless of what is it, right? Whether interest income, dividend income, foreign Canadian dividends, right? Just fill up that. Okay, you reach the level. Okay, now go to RSP. Okay, reach the level. Now you go to the non-reg account. Basic common advice. But remember, you are Canadian Henrys of the world. You can't follow the sheep mentality. You have not been to the position that you are following the sheep mentality. So break that out right now. Remember, this channel is mainly focused for Canadian Henrys, but doesn't mean that it excludes other people or other income levels. It's a roadmap for you if you are not there to understand this thing. So when you get there, you have a better idea than the rest of the people that are trying to get there already there. So here you go. What is your account location costing you? Right? That means where is your account in non-reg account or registered account? In non-reg portfolio, let's assume you have this much amount, right? Your marginal tax rate around this is going to be at least around this. Probably more than this, but let's assume for example, right? The interest asset, let's keep it around here. So look at the numbers. A tax drag is this much. If you just look at this number, it might look nothing for you, right? Well, look at this one. Compounded for 20 years, you're losing $26,647. Imagine 26,000 in 20 years. It might not look more, but you're just giving away for not understanding where to put your income. And this is just a lower level, right? Let's drag it out. Let's see if you are in a portfolio of this, which is not uncommon for Henry's, right? That is the whole goal. Look at this. Now the number becomes big, right? 95,000. And I hope for all of you that you make it to year to $1 million. I really hope for all of you. Look at this one. 202 212,969. Imagine this much money is just gone and it will not show up anywhere as we discussed, right? Because you will never realize it. What you can do with this much money in 20 years? Probably a lot more, right? And this is, remember, it's not going to be the same tax rate if you're on this level. It's probably going to be, you assume it's going to be half of it, right? Now look at the number. $245,000 is just gone just because you're not aware of where to put the money in. And it will never show up any statements anywhere. It is just gone into thin air. That's why I want you to pay attention of where you put your investments in. Very critical than actually choosing the investment as well. So now you're thinking, okay, now I have the information. What do I do? Welcome our action plan. Three moves specifically, right? First one, move interest bearing account or asset into RSP or TFSA. This will be, as we talked in the first slide, GIC, bonds, ETF, HISA, high interest saving account, in non-reg account, right? Because if you move it from non-reg to these accounts, you will not pay taxes as long as it stay inside the account. Remember, it needs to stay inside the account. You can't just have it, pay no tax, and then remove it out, right? You can do it in TFSA, sure, because you have mobility to move it, but not in RSP. So remember that as well. Just not follow this blindly, going, okay, I'm going to put that money in. Once I get this interest, what I'm going to get, let me remove it out, right? In RSP, you definitely can't without severe penalties. In TFSA, you can, but be careful what you're doing, right? Second, hold your US equity exposure through RSP. So we talked about in this XEQT because they're going to withhold 15% of it, the IRS, VFV, same inside the RSP because of the Canada US treaty. Remember, if you're going to hold these two specific ETFs or similar to this, RSP, not TFSA, they don't have treaty with US for TFSA, only for RSP. Remember this thought. Third one, claim the foreign tax credit on your T1. As you are aware, T4 is your employment income, T1 is your investment income. So if you hold this foreign dividends into a non-rich account, check the line 4050 in your T1, correct? Remember to use this thing to get your foreign tax credit to reduce your taxes. That's the important part. So this is not shown just for showing you this information. This is because to reduce your taxes, because let's be honest and real here, the whole goal of your investment journey in Canada is to lower your taxes so that you can use the money with your discretion rather than paying to the government. That's it. If you have taken one point of this, that's my whole idea. Reduce your taxes legally, of course. So you have discretion to use your funds as you want rather than giving to the government, and you know what they have done with your funds in all these years. And that is not going to change. Finally, you're probably investing in the right things. This means you might have your perfect portfolio set up either in stocks, ETFs, whatever you're choosing, right? Now the important question is where is that sitting in? Specifically in non-registered account or registered account, because that, as we have shown, is going to change your trajectory completely. So to summarize, for RSP, the best asset to put in is interest income, foreign dividends, US equities, in our case, on this example, XEQT, VFV, because of the US Canadian treaty. Only for those interest, only for those assets, you put it in RSP. For TFSA, you put the high growth equity because it can grow inside there. Tax compounding is free, but remember, no cash or bonds over there because that is why RSP is there. And for non-rich account, capital gain, heavy equity only. Canadian dividends acceptable. If you're not sure why, because remember when you sell it, 50% exclusion only when you sell it. If you just keep it, nothing is coming out as long as they don't pay any dividends. That's why all the dividends are going in these things, right? RSP or TFSA. And the final line before we close this thing, at a 43% marginal tax rate, the account matters as much as the asset, probably more. That's a very important line, correct? Because where you put your assets, in which account specifically, matters more to you rather than what is inside this thing, correct? Because that is going to show you how much taxes you are saving and how much investment or retirement pool or retirement money you will have at the end of the. For a closing, as always, I believe today was a good episode. I hope you got some good intel or information about it. I provided some good value to every one of you, and I hope I Aikida my way towards your mind, if you know who I'm referring to. So, if you like the episode, make sure like and subscribe. We're trying to grow here, as I said last video, trying to build something meaningful and not just fading away with just going up and then completely going down. But we need your support, Henrys, or person watching this video. Subscribe to our channel, like the video, share this to much more people that you think need to know this. And let's help every Canadian, regardless of Henry or not, one information, one bit at a time. And let's spread the knowledge so we can all achieve our retirement goal and quit the rat race as soon as possible. Thank you for listening. Hope you have a great weekend and take care.